Hey guys, how is everyone today?
I am excellent. How are you, Shane?
Great. Um, I can't see who all's in, but I am told this is a pretty well attended event. Couple reminders to everybody watching: we are streaming live on LinkedIn. This is a conversation. We want to keep it wide open. Wide open. Um, Feel free to ask questions at any point. Jose will um, let us know as the questions come in the comments. And then there will also be a Q&A session at the end of the event, so anyone can hold questions to the end. Um, I, my name is Shane Bird. I'm with Texas Energy Group, and a board member at Crypto Power. Um, and I would like to allow each one of the individuals here to introduce themselves. Mehdi, you wanna kick us off?
Sure. Hi, everyone. This is Medina Seri from Load Team. Happy that we could finally launch this online webinar series, and happy that we are partnering with Crypto Power Team to have a really valuable conversation around the entire process of initiating a mining site all the way to managing on a day-to-day basis. So excited to have it. But I already see many people joining from LinkedIn, from the link directly. Happy to have you all in here. Thank you.
Thank you, Mehdi. Nima, you want to go ahead?
Yeah, for sure. Morning, everyone. This is Nima from the LOAT team as well, and I'm excited to be here to have a conversation from permit all the way to power and strategy. So excited to be here and looking forward to the discussion and some of the questions that people have in this industry.
Thank you, sir. Mr. Ballard.
Yeah. All right. Thank you guys for having me on here. And like Nima and Mehdi, I'm happy to be getting to partner up with those guys to not only do this webinar, but work together on kind of expanding everybody's footprint in the state of Texas. And yeah, I've been in the mining space for a while, and been working with TEG and Crypto Power now for a while too. And just happy to be here.
Thank you, sir. Mr. Miller.
Yeah, Chris Miller. Appreciate the opportunity, everyone. I work with Texas Energy Group, specifically on the infrastructure side with Power Infrastructure Partners. I've been in the power and infrastructure space for quite some time, and then been working with various crypto clients, since the great land rush, in Texas a few years ago, and yeah, really excited about listening to some of the other speakers here, as well as dropping in some knowledge where I can. So.
Thank you, sir. Well, guys, we're going to have several different topics. This is kind of a permit to power discussion. We want to be collaborative. I will open with with the topic, and I will start the conversation with a question or a comment. But we really want to get everyone else involved, and we want to know your thoughts as well. So please feel free to interject at any time. With that being said, Jose, if you can move us to the first slide, from site to strategy, energy traps to avoid during land acquisitions, and with the influx of load requests and the increased transmission constraints, exorbitant lead times on material, everything from ERCOT to build out, we see demand increasing in the industry, and it's what everyone's talking about. This is causing project delays. It's causing a lot of people to start to change their strategy. How can site selection alone, design and appropriate scheduling just alleviate some of these in our great state?
Um,
Justin?
You want me to jump on? I'll grab this one. So there's been changes. Chris mentioned the kind of land rush that happened a few years ago. That was really about 2020 when that stuff started really kicking off, and there was really starting to be an influx of miners come to Texas. And then with the ban on mining in China that happened, I think it was May of 21 or April 21, around that time frame. We saw the real influx start, and that was, people were kind of flying by the seat of their pants, including myself, on putting a lot of these opportunities together. Luckily I came from the oil and gas space and worked on doing the same type of deals, and there was a lot of correlation between them. But things have changed with the utilities and the regulatory body, ERCOT, over the last 4 or 5 years in particular, due to just this kind of influx of load sheets being submitted, people trying to grab power. We've all seen the numbers of requests that are into ERCOT, right, or Encore right now, or any of the different utilities for additional load, and it's just kind of gotten crazy. And so that's why a lot of the utilities and state even have implemented some new rules and kind of requirements to show that you have an interest in the land. And I think a lot of this is designed to basically, I'm sure we'll use this word a lot, curtail the amount of real requests that are out there, and kind of get through the, for lack of a better term, BS that some people throw out by just submitting large load sheets and all that. And so one of those things is requiring there to be an interest in the land when you're submitting some of these requests. So that does make it a little more difficult, especially on the timing side, because as I know we'll get into this, the timing constraints on when a site could actually have energy being delivered by a utility can vary greatly. And I think one of the things that people underestimate is that you're working with almost like a quasi-governmental entity, and when they tell you a time frame, they also have the authority and ability to basically change that whenever they need to. And so being very, very thorough on the land up front is probably one of the most difficult things, because you're going to have to lock up some type of interest in land, whether that be an option, a lease with some type of effective date or operational date. Just getting a lot more creative on the leasing strategy or even the purchase strategy, because as we all know, capital is constrained in the mining world. Even though things have gotten better on the regulatory front, there's still some aversion from investors to jump into this world. And so you got to be more strategic with your capital and where you're deploying it. And that on the land side is one of the upfront costs. And so I think being very thorough and diligent with the utility up front and getting land at a cost with the flexibility that allows you to basically move if the schedule's not going to work, or delay the effective date, and basically having ways to kick the can while you do your due diligence is getting more and more important. So, I would tell you one of the things that I've always tried to do is make sure I would rather pass up on an opportunity than get into one that is not very settled on the delivery date of energy. There's going to be more. You don't want to you can get yourself out over your skis a little bit if you get there too fast. But so I'd just say one of the things to watch out for is making sure that you are not tying yourself to an asset with expectations of power being delivered on the first, conversation you have with the utility. There's going to be studies required. There's going to be delays that happen, and you need to factor that into everything you do on the land side.
Yeah, I feel like that could be a whole another hour just on that topic right now. I know from the infrastructure side and building lots of infrastructure, 2 years ago, 3 years ago, we didn't even have to have site control on a substation location, right? And now we have to display ownership or a lease of contract of some kind. So, Miller, can you speak to that particular piece of it, and then the build out of some of this equipment and the delays that can cause?
Sure. I love what Justin said about just maintaining the optionality, and now I think we're seeing it where, I hate to use the term, beggars can't be choosers, right? There's not a lot of sites, there's not a lot of available load, and so while I can appreciate, certain people, I got to get land, I got to get into something. It's almost like at the end, they're so focused on power and being energized, they end up putting themselves in very, confined or just really difficult, land shapes, sizes, acreages for what they're trying to accomplish. And then it comes back into, okay, well, how do we get this many megawatts in this type of shape? And they really haven't had that learning curve yet of understanding some of the limitations around infrastructure design, and then also with the technology constantly changing, the megawatts per foot or megawatts per acre is constantly evolving and changing, and so again, I think it's got to be kind of in parallel. You have to kind of know what types of units you're going to be running, what the limitations are of your infrastructure, and ultimately the usability of that land that has become extremely precious, and you may not want to pass up on it. So again, we've seen some people put themselves in some really challenging situations where their infrastructure cost build out are substantially higher than what they expected, simply because they weren't having those discussions while working with the utility on, hey, what can fit here? What are our constraints? And where can we, again, use good engineering practices, but still maintain, cost controls, over how many megawatts we're trying to get into that particular footprint.
Yeah, I'm going to add to that too. Sorry. That's a really good point, because one thing I'm seeing more and more now is as you're getting into those lease discussions, and most of what I'm going to talk is based on leasing. If you can buy the property, obviously that's going to be a lot easier. You're going to remove a lot of the restrictions that some of the lease lessors are coming up with, and their attorneys. Those attorneys, man. But one of them is there's more and more restrictions on air cooled as you get closer to cities, or even as you're closer to some residents that might be in rural areas. That is one thing that I'm seeing, and that's another issue with like chicken or egg type deal, is if you're getting out ahead of yourself and you haven't done a lot of like due diligence and you got expectations, say you're talking to utility and you haven't locked down what the terms of the lease are, you don't want to go in expecting to do an air cooled operation and then find out that the lessor is only going to allow you to do a hydro cooled operation. That is happening a lot more. I don't know if you guys seen, there was some stuff over at Texas A&M that just basically the city said no and is not going to allow an operation to go forward. But so that's something to keep in mind. Like Chris was saying, you don't want to get into this and all of a sudden find out your capital cost is going to be tremendously different, or your footprint's going to be tremendously different because some type of operation is excluded or restricted that you didn't kind of factor in before you went down the path of engaging things and paying money to a utility. And so there's just a lot more land work that's going to have to be done up front now than it was in the past. It was almost in the past, you get an FEA and you basically figure the land out afterwards. Completely flipped now. It's kind of like you got to make sure the land is going to work. You got to have an interest, and then you get your FEA. So yeah, there's just something else to keep in mind is know that the lessors in Texas, just like what happened in oil and gas, they get more and more sophisticated, and they're going to start a lot more restrictive on what is allowed under the terms of a lease.
Yeah, you mentioned getting out over our skis, and I think that'll move us right into the interconnection realities on the next slide. It seems like, Justin, you said a lot of people can't get the their FEA, they can't get their interconnect, they can't get that done. So they move, they shift their focus to, all right, let's go get land. But then they get out over their skis because now they've secured some property, whether it be lease or purchase, and now they're waiting on the utility, right? And
Right.
and that capital.
I'm laughing because I got this exact scenario going on right now. But go ahead. Sorry.
No, go ahead. Elaborate, please.
Well, okay. So, I work with a lot of groups, and so I do deal with different scenarios. Not all of them in Texas, some of them in other areas. But, I've been talking to some groups on some deals I'm working that this was back in, say, March, and from the utilities, no studies required, none of this, none of that. We're good to go. This is the timing of it. Power's we're energized already. We can deliver that as fast as you can get there. Well, obviously it's September, going on October now, and come to find out that's not what is accurate. And so, multiple trips back to landowners to try to explain why we need to delay the signing or add a clause that delays the operational time frame required, because you still need that 5 years. You know what I mean? You still need that 5 years of operating term in order to hit some economics. Well, we're 6, 7, 8 months into discussions after a term of a lease started 6 months ago. And so we're still working on the utility now, and capital's been deployed. And so now you don't want to walk away because you've already deployed some capital with the utility. You've already deployed capital with the landowner. But now things are kind of slowing down, and you've had to delay your operational time frame by 5 or 6 months. And that can eat away at the economics of that site. We don't know who everybody on this call is, but whether you're a big company or a small company, different things can impact you more. But if you're a small to medium-sized group and you deployed capital for something like that, it can be very detrimental or even catastrophic for your economics. And so it's very much kind of a feeling your way through in some sorts, but understanding like things can change. Utilities can do pretty much whatever they want. I don't know how many people on here have tried to go pick a fight with an Encore or an AEP. I don't. If any Encore or AEP people, I love you all. I'm not going to try to fight with you guys, but I'm just saying it's not going to go real well usually. And at the end of the day, you want to maintain good relationships with them. So, and same with the landowners. We all have a duty in order to keep pushing the industry forward to do right by the landowners too, right? And make sure that like what we tell them is what happens, because we don't want it to turn into a situation where we've already got people that are anti-mining and totally against us. So we don't need to further that narrative by not living up to our obligations or honoring what we're telling landowners. So just be very diligent, because you only get one crack at it. You ain't gonna get you screwed up with one of these landowners, you're not going to get another crack at it in that area, especially these rural places. And I don't know how many mining people come from the oil and gas space, but you figure it out real quick in that world. And once you screw it up, you ain't getting another chance. So it's a very small community. The landowners community is very small too. So, be careful about what you're doing, honor your obligations, and be very diligent up front. Spend the time up front so you don't have the problems later on.
Yeah, you spoke to the backlog of the queue, and everybody's aware of what's going on. We got a great question from Jonathan Kahn. Are you all seeing sites get approved at distribution and turned down at transmission in this process?
Yes. And not necessarily turned down all the time, right, but the timing aspect can. And what's up, Jonathan? I know you, man. Hope everything's going well. But yeah, it not necessarily turned down. And I'm sorry, Chris, you jump in there too. I know I'm jabbering away, but delayed tremendously to the point to where you might as well walk away.
Yeah, Miller.
I'll say it a little differently. From a physical standpoint, the lead times associated with distribution upgrades are literally a fraction of the upgrades required for transmission upgrades. So again, depending on the area, a particular area, even the distribution could be transmission limited and require transmission level upgrades. But in terms of the lead times of materials for the TDSPs or a utility to upgrade distribution, really are a fraction of some of these multi-year lead times that we're seeing on transmission level components to support those upgrades and projects. Great question. So.
Yeah, great question. And we live in this new world. Justin, you touched on it a little bit about the utilities, having the ability to tell you one thing and then do something else, and a lot of times that's not at their own control, right?
Right. Yes. Again, I'm not trying to rip on them.
Yeah, absolutely. We've got ERCOT and the PUC. They're in rulemaking session right now, trying to figure out what all the new rules are. The utilities don't really have any guidance in many cases, and it's changing every day. Are we doing cluster studies? Are we not doing cluster studies? Are we taking these loads in independently? And the rules aren't clear for us, right? And so how has this affected the procurement of power in a timely manner? But more so, how do we navigate that going forward? Especially with, I'm going to say it, with the data center load that's out there right now, and having 200 gigawatts of load in the queue,
Yeah. Well, first of all, ERCOT and the utilities, they're really getting tasked with something that, I think all the utilities in some level are, like, regardless of what state you're in, but Texas especially, and they're having to basically develop things from scratch based on a problem that nobody really saw coming 5-6 years ago. You know what I mean? And legislation and regulation always is behind technological advances. And so they're trying to basically formulate rules and guidance to, streamline a process that is very difficult to streamline and bounce around and change. And then they gotta change too. And so it's a complicated task for them. It's a difficult and complex task for them. And I do think that they are trying to do the right thing. Like, I don't think there's any ill intent or bad moves by them. I think it's just an effort to basically weed out things that are, like you said, 200 gigawatts of requests. Some of it's absurd. Not all of that is coming online. But they have to treat it as such, and they have to give it they have to look at it as if those are. And so there's just a huge backlog of things that they're dealing with. But I do think that navigating that with them and showing some grace to them to, let's help them try to regulate these problems together, and follow these rules the best we can. But I don't know what the future is going to be like, and I do anticipate more changes. But getting through this backlog is going to be a problem. And so until they do, I think a lot of this stuff's going to be in flux. So, I don't know if that answers your question, but I think it's the reality of the problem they're dealing with.
Right? I don't know that there is an answer to the question. We're just all aware of the issue. That kind of moves us.
One question, Mike. So is there a secondary market for developed land or energized land that enables people to get ahead of the queue? Is it something that you all see at Crypto Power?
Man,
I think we're seeing it in different stages where, people are allowed to market and promote whatever they believe they have. But I think what we see though is if you didn't get out ahead of this, then your project's really far down the road, and you're outside of some of these other constraints and regulations, and you really do have documentation in hand that gives you line of sight to a date of energization, right? And it's reciprocal with the utility. I think what we see now is there's a lot of land out there, and there's a lot of, hey, we're in studies. What does that mean? Are we 24 months out? Are we 18 months out? We still have no line of sight to any type of energization. And so that secondary market, while it's very active and we absolutely see transactions occurring, this comes back to kind of at the very beginning what Justin was alluding to. The buyers and the companies in this space are have to get better at their due diligence and asking all of the questions and flushing out what's really actionable and what is defensible, and then adjusting the market accordingly. We've seen some things trade at some pretty serious premiums, and they're still not energized. And then we've seen some other things change hands, and hey, they're up and running, they're energized. So again, I think that kind of comes back to flushing out that secondary market and really the investment community becoming more savvy in their due diligence and how they really get to hey, what kind of asset am I buying? How does it fit into my timeline? And where does it fit into my capital stack? Knowing that I could be 24 months from revenue or less. So.
Yeah, and I think Mehdi too on that. Like, I would love for there to be a great secondary market where there's like, here's some sites that are ready to go. You know what I mean? But I think it goes back to the lack of capital that the space has, the lack of excess capital, right? That I could go, all right, here's my asset, but I'm going to go deploy some capital over here and get this stuff ready over the next 2 years. While there's just not enough free capital in the space to go do a lot of that. And then you got a bunch of, land brokers that will pop up and they want to get an FEA and then flip it to somebody, but you got 30 days on some of these FEAs to get a deal done. That's difficult. And then it's like, do you also have the land already locked up? Well, you should at this point, but in the past that was, you could get an FEA without having the land. And so you're trying to sell this, but then they got to buy it and think that they're going to get a land deal done. It's just, there's so many things that go into it. And so you get a lot of, like Chris was just saying, you get a lot of noise from some groups that are like, hey, I got this and I got that. Do they really have it all buttoned up and ready to go? There's very few, right? There's not a lot of that yet. There's a lot of development type deals that you can do. Like, hey, you've proven yourself, we'll engage you to do this. Here's some milestone type payments, and you have a group that is skilled at going in, getting the land, working with the utility, all that type of stuff, which is, look, obviously plug for us, but that's what we do, some of that. Okay. So like we can work on that with you. But that is, it's not a very mature area yet, Mehdi, in my opinion. There needs to be more capital deployed and groups popping up that actually get things put together and then go market it as like, hey, here's a marketplace of opportunities that are checked out, ready to go, buttoned up. Here it is.
Yeah, it's that whole chicken and egg thing, right?
Mm-hmm.
And
never ending, man.
Yeah,
it's been 5 years.
Are you capitalized well enough to handle the carrying cost? Right.
Right.
I mean, so.
Well, I'm gonna move us right along into the next slide and kind of turn the discussion to managing what we have, rather than what's on the horizon, and talk about demand response and building flexibility into every asset that you do have. And I'm gonna kind of shape that for new operations. It seems like energy arbitrage opportunities don't exist like they used to, in a couple of years ago at least, in increasing power prices, right? And so, what is the best procurement strategy and the best ancillaries to participate in as you move forward in your operations? I'm gonna direct that to you, Mehdi.
So, yeah, we just discussed, like, we have a land, it's energized. Now we want to start operating it. Like, we want to like define what is the power strategy, how could we increase our profit margins. Like back in early 2020, let's say before 2020, the strategy was secure the land, secure the power, and just do 100% uptime, mine as much as you can. But that's not the strategy anymore. Like, our analysis shows that if you can adopt some levels of flexibility, you can increase your profit margin by 70%. That's a huge difference in terms of like how long you can run your business profitably. Or let's say if you could actually scale your business to the next level. So that's quite important. But there are many different pieces of the puzzle that you should put together when you are like defining your energy strategy. Obviously, when we see sites like being developed or let's say going live, people usually start gradually, like defining like a basic strategy, then becoming more and more advanced. Uh, like starting with basic 4CP strategy, basic price strategy. As Shane mentioned, like 3 4 years ago, people were looking for hedges or PPAs to lock in a really low cost of power. But anyone who did that for a longer like than a year or two, they're now in loss. Like they're losing a lot of money because they locked in their price of power while while power prices are actually much lower, or their Bitcoin machines are not profitable anymore. So the strategy could change from month to month. Like it's very dynamic market. The regulations are changing. What we're seeing more often happening these days is people are running naked on the index, right? Like getting exposed to real time prices and choose which electron they want to offtake from the grid.
Right.
But at the same time, that real time price strategy is one angle. What defines your profitability is how would you be supporting the grid? How would you be a good citizen of the grid? And grid incentivizes you to become that. So that includes saving on your transmission distribution costs. Technically, they call it like 4CP in ERCOT. And on top of it, what programs do you get involved with? So those programs could be like kind of a more classic program such as ERS, or more advanced day ahead market programs for ancillary services, which is again like going through a lot of transformation these days. Uh, uh, what else do you guys think we should be covering here? What are the downfalls of like power strategies that should be mentioned?
Yeah.
Man, I think. Oh, go ahead.
Yeah, so sort of going back to Mehdi's point, when we started in the early 2020, late 2019, the one of the first way of earning revenue for Bitcoin miners was just your hash rate, right? You're getting your mining rewards, hitting those blocks and getting paid for your hash rate power. But as miners start to grow and they scale up, they have an opportunity to become a grid partner. That means they have the ability to participate in different programs. So, like Mehdi said, like your ancillary services, you can get into actually power trading, and also like some of the financial products that you can get into, like your PPAs, and where you would have the opportunity to actually um, further you further utilize your PPAs by having the ability to sell back to the grid high um during price spikes essentially. These are some of the things I think like Bitcoin miners now need to start taking into consideration as they are getting energized is okay, do I want to provide the capacity to participate in demand response? How much of my capacity do I want to allocate for demand response? Because essentially with demand response, you're getting paid to um, by being available to drop your load when the grid is in tight conditions. Similar thing. Let me just move my similar thing with trading, with energy trading. Right now, you have the ability to trade energy in the day ahead market to pick and choose some of the hours that you want to bid into. And those are areas where Bitcoin miners now need to start thinking more and more about and on how to actually take advantage of those. Because I think one thing we say quite often when we're talking internally, or we're talking with people in the industry, is that it you're not just operating your ASICs, or as Mehdi said, Bitcoin machines. You're actually a energy company, and you have many different opportunities that are open to you to take advantage of every single one of these programs that are out that are offered for energy companies essentially. So
Yeah. Thank you, Nima. We had a question come in from James McCarthy. What about ASIC's efficiency when considering strike prices for programs like ERS? Great question.
Yeah, let me take that one. So, hey James. Uh, so regarding like stacking different programs, it's definitely a must do for a Bitcoin miner. You can't be doing like only LMP or price strategy and not doing ERS. So you have to do all at the same time. But regarding ERS, usually the way that people are doing it is when they get involved into the market and into the program. Uh, they like ERS participation comes with some levels of like compliance requirement in terms of uptime. As long as you fulfill that uptime requirements and your QSC is fine with that uptime that you are providing to them, or they can just like cover for your risk of downtime. Technically, you can just curtail at any price that you wish. What that price should be, that means that like the price should be your break-even point. That could change actually on a per minute basis based on real-time Bitcoin network condition. So as a result, you have to have either a real-time, like absolutely real-time strategy, or you have to like be updating your strategy on a daily basis based on what's going on the network level. So that's definitely a key consideration when making that happen.
Yeah.
What's up, James? By the way, I'm still upset that dude didn't invite me to his wedding.
I have another question from Rashid. Can you explain in detail how do you propose optimized uptime during 4CP curtailment hours with real-time telemetry? Nima, you wanna take that one?
yeah, sure. Rashid, isn't that like that MMA fighter? Maybe,
Better watch
yeah,
out.
so I gotta watch what I say here. Yeah, so how do you optimize your uptime during 4CP hours? So one of the things, something that many um miners are used to is that, you know, they would receive signals from their queasy, you know, that you need to curtail on X day. You know, tomorrow you need to curtail from 2 o'clock to 7 o'clock or 4 o'clock till 7 o'clock, something like that, right? And generally, this is a great strategy um, to comply with, right? Because you're avoiding those peak hours, and you know you have multiple days where the chances of 4CP event happening, you're avoiding those peak hours by curtailing, you know, 4, 5, 6 hours. I've seen it as high as like 8 hours in a single day. And these are just valuable time that you're missing out on, where you can continue to stack your Bitcoin essentially. What we are seeing more and more, and some of our users as well, and some of the larger scale miners are they're actually getting involved in receiving real-time grid data on what the demand is, and um, curtailing based on actually grid events. So when the demand is actually getting near to a point where they need to curtail in order to avoid a 4CP pick, that's what they're actually doing. So like what they're doing by relying on real-time grid data, they're actually reducing that 8 hour window that they have down to about 2 hours, 2.5 hours, sometimes less. I've seen it as, you know, as less than 1 hour. And now you actually um you're increasing your uptime here. You can continue to hash during those few extra hours. You know, every hour for given the current condition, every hour for per megawatt is about $100, right? That anytime you're down, so it's about $100 per megawatt per hour that you're missing out that you curtail. So um I hope that answered your
One thing,
question.
yeah,
I
let
may
me
have,
add something
yeah.
to it, Nima. So back in 2022, 2023, the dynamics of the grid was so much in line with 4CP. Like the price was spiking during 4CP all the time. However, as of last year, with like because of like so much solar and battery on the grid, we are seeing that the prices during 4CP are actually pretty low. Sometimes the price goes like negative even in those hours because the grid is like overflowed by solar power. So it's important to have that real-time strategy. Another point that I think makes it more important was an incident that almost majority of people faced last year in 2024, that the 4CP actually happened on a day that no one was expecting it, and no predictive signal was telling people that tomorrow is going to be 4CP, and like many people missed it except the ones who had real-time strategy. One more challenge with real-time strategy, Rashid, like is that you should take into account is ERCOT does not use their own demand data to calculate 4CP. The real 4CP calculation is done by deducting their like the exports and the storage load. So you have to have a more advanced real-time strategy to find the actual demand data. We call it like EST data internally, that like a storage and export is deducted from it. So that's important to have that real-time strategy, but eventually you gotta maintain some levels of conservativeness around that. You don't want to like actually track the peak. You want to set your thresholds. Let's say like on 99%, 98%, 97%, in order to dynamically minimize your downtime and increase your profit during those important low price hours that 4CP is happening. So that's I hope that answered your questions, but please feel free to ask follow-up questions to clarify any of the points.
And I'm gonna add to that because I don't think Nima and Mehdi, I know this is a load and TEG webinar, but they're being kind of diplomatic. Load the software, their platform has helped me in the minds that I have interest in tremendously by reducing the time that like just like they laid out, reducing the time that we actually end up having to curtail for a 4CP event. Like I'm going out, and I know I'm probably biased, but I will go out and I will say that their platform has tremendously helped us reduce our downtime for those curtailable events because of using some of the data that's available through Load. So good job, Mehdi and Nima. Great product.
Thanks, Joss. Thank you.
That kind of moves us perfectly, segues us into the next slide, and just how building an automated strategy can keep us in compliance and keep us in revenue.
Awesome.
Mehdi,
So,
yeah.
compliance, yeah, 100%. So technically, if you're mining Bitcoin in ERCOT, ERCOT is the like my favorite energy market to mine Bitcoin in, mainly because you have a lot of freedom how you want to play. But as soon as you start to get involved in more grid programs, compliance becomes a necessary part of the job. As I told you, like a quick example could be if you are doing ERS, that like many Bitcoin miners participate in ERS, Windows or ERS programs. You have to have to maintain certain hours of uptime in order to remain compliant with ERCOT requirements. Many people don't do it. Not necessarily everyone enforce it, but I imagine that would become more and more important moving forward. On top of it, like more advanced programs such as ancillary services and CLR, those are also like areas that could potentially bring in more profitability, especially as the competition gets higher and higher across the market. So when you are doing ancillary services, again, there are certain compliance requirements in terms of maintaining your uptime. And on top of it, CLR program that many people talked about it, but no one actually was getting involved in it because of the requirements, is becoming more Bitcoin miner friendly. A new update is coming early next year that they are removing primary frequency response from CLR. So as a load resource, like as a Bitcoin miner, you can become a controllable load resource and respond to real-time SCAD signals. Uh, Actually, that becomes important. That becomes relevant to this webinar because if you become a CLR resource, you can play a land game. Like depending on where you are located, you can get exposed to nodal prices and potentially unlock a huge potential based on where you are operating at. Maybe like this could be something that Crypto Power team could also add some notes to it. But finding a land wouldn't be only about permits or let's say all the requirements. It could also be a historical analysis that you run on the node based on historical prices, because all of a sudden you have one more knob to manage. Chris, you want to add anything to that?
Sure. I mean, yeah, we've definitely seen some of the more sophisticated investors and customers, strategically look at land in specific zones, throughout the state. And if everything is equal, invest in the property that is located in a more strategic zone or closer to something that would allow them to get access to that nodal pricing. Absolutely.
Okay.
Yeah. Well, I guess we're going to move right into the Q&A. I saw in the comments we had a few questions, and one of the LinkedIn users posted, there's utility companies charging over $100,000 deposit for a load study now. I assume the high cost is to weed people out. And that's a great question. We deal with it every single day. We talk about it all the time. I've personally had conversations at the upper level management of Encore and LCRA, and that is almost exactly what it is meant to do. Do you have a real project? Do you have line of sight, like we said, to site control? And are you funded? And there will be, going forward, you will hear conversations about securities up front and those type of things to further weed out, like you say. Miller, you want to elaborate on that at all?
Absolutely. And some of what we're seeing, $100,000 is cheap. So I'll kind of tie it back into something we were talking about earlier, which is the utilities just getting completely inundated. 6-7 years ago, the staff they had could do the dynamic modeling and all of the other models and impact assessment studies required within their own bandwidth. Some of these fees, yes, it is to weed people out. The other thing is the utilities are outsourcing this to engineering firms and third-party companies that are actually having to perform these studies as well. So it's a way of pushing some of the costs that they used to absorb, out to others. So it kind of serves two purposes. So.
Absolutely. Yeah. And in a lot of your utility areas, especially in your co-ops, you have the option to actually third party out those load requests, and you can go to someone and say, hey, I want to expedite it by paying for it, and those studies aren't cheap.
Correct.
Jose, what's our next question?
Let me add a question while we're waiting for, or
Go ahead.
let's take this one, and then I'll ask my question.
Okay.
Rashid
what do you think is the question? Price? When do you think the right price level to turn off operations to balance frequency or pauses and uptime?
That really depends on what you're running. Depends what Bitcoin machines you have. Right, Matt?
Yeah.
It depends what miners you're using, because they're going to have different strike prices for turning on and off and whatnot. So I think that's really kind of machine dependent. A lot of the stuff that I'm on is hydro, so we have a little bit higher strike price, which is nice for us. Allows us to mine kind of longer periods of time, but there's drawbacks to it too. It's not as easily curtailed and doesn't come online as easy. So it just depends what your situation is, and you have to look at it kind of on a very subjective level, and before you could really come up with something that would work for you. But that's why we do what we do too. If you have questions and got to specific situation, then reach out and we can help you walk through that and find out what it is. But yeah, it's really just completely dependent on what machines you have.
Especially if you're running an operation that has different types of machines in it or Bitcoin machines in
Mm-hmm.
it. So you have to have different strategies per machine type, or let's say per section of your operation, because as Justin mentioned, the ramp up time, or let's say the loss on the ramp up time, is different per machine. So uh, what you want to do, you want to have the right tool in place. Again, load is could be that tool that manages that pause time, or let's say the filter that you could define of what spikes you want to filter out and you want to like avoid going down because of something that might be very unnecessary.
Yeah, and I want to elaborate a little bit and ask another question. And Nima, the load software can actually help you figure out what those strike prices should be for your facility, right?
Yeah,
Yeah,
100%.
that's I think that answered it, I guess. But yeah,
Good.
no, for sure. Yeah, on the dashboards, you're able to view the chart for past few days and forward looking, and also forward looking, and over there you can actually see what your spikes are have looked like in the past, when you can potentially expect spikes in the near future. But one thing about the question here, I think, is actually not about understanding like what price level to turn off, but rather based on the type of ASICs that you're running. Taking sort of elaborating on Mehdi's point here, is based on the different type of ASIC that you're running, you actually come in and control um, how much how much price can you tolerate before having to curtail your miners, right? Having that extra buffer in there where you staying on an extra 10 minutes, 15 minutes or so, it would greatly help you to avoid those, 5-10 minute spikes
Mm-hmm.
where you might be taking on a higher price. You might be mining at $150, $180 or something like that. But after that 5-10 minutes, it's going to drop back down to normal prices again. And if you're running like what's miners, those are the times you don't want to be curtailing. You're most likely better off staying on and sort of riding that 150 $180 for 10 minutes or so, instead of curtailing it. I think that's probably a better thing to take into consideration of how much price can you tolerate. Um,
Mm. At the
so
end of
I
the
would
day, it
keep
is a
that in mind as well.
co-optimization game. Yeah, you can't just like
Mm-hmm.
optimize for price. You can just optimize
Right.
for ramp time. You gotta like do it all at the same time. You can't just optimize for power strategy. You could optimize for land. So, as someone who is building a business or scaling a business, that's all you should care about.
Okay. Mehdi, you had a question before that one came in.
Yeah, that was mainly on collaterals. Like, how do you guys, especially like on the land and power side of things, do you see the like where what are the like hidden collateral expenditures, or let's say hidden collaterals that like a Bitcoin should be prepared to provide, and what are the ways that you could use to actually minimize those collaterals?
Yeah, that's a very good question, Mehdi. So yeah, collateral. I think people are getting a better idea that that is going to be something that's a big cost, like a big number item that they got to be prepared for when they're putting their mining operation together. But there for a while early on, like that was one that people all of a sudden are like, wait, well, I have to do what? I got to put up $2 million for this or that. And yes, that's typically the case. Like I know some of the deals I'm working now, you're looking at 2 months collateral, based 2 months of power prices for collateral. In addition to some what they're calling performance assurances. So there's multiple collateral pockets that people are having to do. Depending on who you're working with, if it's some of the co-ops, They got some really, really strict collateral requirements, and they are not typically open to groups like Sonoda coming in and handling daily pay. Even that might make sense to you on the face of it. People are still learning this. All of us, and probably most of the people watching, we are all in on Bitcoin mining. We're all down with it. It's not weird to us or foreign, or we've bought in. There's still the vast majority of people that you're going to talk to when you're trying to get a mine up that are outside of the Bitcoin world direct. They don't know a whole ton about it, and so getting them comfortable with taking on some risk themselves, because they are all at risk in the event that our operation goes south, in the event that we miss a payment. 2 weeks of power bills for a 25 megawatt, 50 megawatt site is a lot of money. Okay. And they need assurances that we are going to meet our obligations. And so whether it be just the power price, cost of power for 2 months, or additional performance assurances, yes, we are seeing those a lot. One of the ways it's been effective at trying to reduce that sum that I've seen, obviously Sonoda has stepped in and remove some of the collateral requirements that utilities are typically looking for. But other ways that I have personally talked with some of the groups about is having the ability on the supplier side or the co-op side to basically shut power down in the event that that certain obligations are not met. That's a big give by a miner to give that ability to the utility or co-op or whoever it might be. But it's one that if you are needing a way to reduce a collateral requirement, some groups, suppliers or utilities or co-ops, some of them are open to it. And so that's one way that I've seen them effectively being able to reduce the collateral requirement up front.
Well, it looks like James asked another question. Thank you for that input, Justin. Do you guys see an ERCOT utility? Do you see any ERCOT utilities bringing in performance guarantee deposits like utilities such as PSO in SPP on top of the energy deposit?
Yeah, I can kind of speak to that. So I think it'll be some of what Justin was alluding to, but also what we're seeing on the FEA side is, and this would be for a transmission level project. So you're dealing with hundreds and hundreds of megawatts. Whether it was us or others, we used to be able to give our customers, the utility was willing to grant a longer load ramp, right? So let's just say 200 megawatts was the ultimate ask. Well, we could do that by year 3 or year 4, right? And not be at risk of any type of, forced curtailment or them taking back the available load. So I think what the utilities are doing now is they're auditing the system in tighter intervals. And so, that load ramp flexibility is more or less gone. You kind of have 12 to 24 months to kind of hit your ask, especially if there's follow-up amendments where you're seeking additional load. Otherwise, they are hunting for megawatts throughout the system. And so the audit intervals are absolutely getting tighter from that. And I think that's going to affect a lot of the structure of your FEA, or ultimately whatever type of deposit, whether it's your upfront security that could partially get released when you hit your load ramp, or just a tighter window to get to that ultimate peak so that you're so that you fulfilled your portion of the obligation on the contract.
Thank you, Mr. Miller. Rashid asked, do you think price forecasts are practical? If yes, who's the best in price forecasting for the ERCOT market?
Probably the last question, I guess, given the time constraint that we have. But I've seen people trying to do forecasting, and there are some forecasting models out there. Some days they do well, some days they don't, because grid is a very, very dynamic system. Eventually, what I see across Bitcoin mining community is that everyone are moving into real-time reactive strategy, like being reactive to energy prices. In addition to that, like where I see forecasting becoming more trendy is optimizing asset across markets, day ahead, real time, or more long term hedges. So that is also another subject that is becoming more popular. But generally speaking, I see people becoming more and more reactive to what happens on the grid rather than being proactive and like be like forecast what's going on.
Thank you, Mehdi. Well, that kind of seals the deal for us. That's a good session, and we're kind of out of time. I want to thank everyone that joined, and I want to thank the panel here. Great conversation. Y'all hit us up on LinkedIn, YouTube, or you can reach out to any of us at Texas Energy Group, Power Infrastructure Partners, or Crypto Power, and of course, Load and Lincoin. Thank you.
Thanks,
Thank you,
Shane.
guys.
Thanks, everybody.
Thanks, everyone.